Hi everyone, I'm coming to you live from downtown Healdsburg in the commercial center of the Vineyard Plaza. Most specifically, I'm inside the restaurant Acai Ramen and Izakaya. I actually just did Ed and I did a quick post about the sale of this restaurant. If you're interested, you can reach out to me. Most specifically, this is Deep Dish Live, episode 19. We missed a month. The restaurant industry has been so busy right now, I barely have time to service this series, which I love so much. Today I'm going to be talking to you about why restaurants fails and how that might affect the restaurant sale. Deep Dish Live comes to you once monthly. We almost always stream from one of your favorite North Bay restaurants. Each episode is about 10-15 minutes long. And we discuss the business of restaurants for restaurateurs, restaurant buyers and sellers, and the restaurant curious. We always give away a gift card from our host restaurant. Today we don't have one because this restaurant is going to change hands soon. But I will be announcing the winner. Ed and I came live to you from downtown 4th Street in Santa Rosa, California, where I featured a gift card from Yarrow Goods. It's a friend of mine, Grace and Oliver Estrada. They just opened a new retail center, luxury, handcrafted, artisan, textiles, hats, t-shirts, all original, bags. Anyway, I'll be calling out the gift card winner, maybe not today, soon. I'll do it on Insta. So today we're talking about how restaurants fail, why it is restaurant fail, and how that affects the sale of the business. So any cursory search you do on the web, you're going to come up, it's almost mythical. We love to talk about how many restaurants fail and why they fail. And I'll tell you, sprinkled into that is some truth and then just a lot of sort of, culture, urban myth. So the percentages about why restaurant fails, if you do a search, you'll be there. It's kind of all over the map about how many restaurants fail, and they usually talk about restaurants failing in their first year, their third year, and their fifth year. You can look at what those percentages are. They're all different. It's not like there's one agency that collects this information, so it's sort of subjective, that data, but we do know that, restaurant industry is difficult and people often fail. So I'm going to talk about 5 reasons plus 1, which would be 6 ostensibly, but these 5 you're going to see on any given list, and my plus 1 is sort of an internal reason that restaurants fail, specifically I'm going to talk about our region and in California, because we Californians pay retail sales tax. So it's very specific. Like in Oregon, you don't pay retail sales tax, so this reason wouldn't apply. So reason number 1. Location. This is the one everyone loves to pony out. I find it sort of a tedious reason. Actually, I think it's kind of old school and outplayed. I think depending on the restaurant type, if you're a quick service restaurant, yes, location, location, location. You've got to have traffic, easy in and out. You have to have parking. You have to be operating in a city or an area that allows for drive-through restaurants. Drive-through, the city that I live in, many cities in Sonoma County are putting moratoriums or bans on pass-through restaurants due to the carbon emissions that are caused by people sitting with their cars idling in drive-through windows. So yes, in that instance, a location matters. But for me, I work very little with franchises. I work almost exclusively with independent operators with single, multiple, or a handful of units. One of my clients probably has 8 or 9 units, but most of my clients have 1 unit. So when I want to tell a story about location. When I opened my restaurant, I found a restaurant that used to be operating. It was designed and built to operate as a Kentucky Fried Chicken. It was a freestanding building, and it was so cool. It was like the 70s, like lofted ceilings. It had a drive-through. It had an open line, which means an exhibition kitchen. Like you're sitting in the dining room, but you can see the chef cooking away, which is my favorite. I was a chef operator, so I wanted to see and be seen. I wanted to be able to engage with my clientele because I was the one back there cooking. It had been failed restaurant after failed restaurant after failed restaurant for many years. So this was my very first restaurant. I'm a young woman. I was putting everything on the line to open this restaurant, and I'm not kidding. People would pull when I took occupancy, but I wasn't yet open. People would pull in, open the door to tell me what an awful location it was, that it was cursed. You guys, I had a wildly successful restaurant. It went on to a handful of other owners. It had a 15-year run. It had a sad end, which I've talked about in other episodes, and I'll talk about another time. It's not pertinent here, but it did not fail. So location, and then I could talk to you about so many crazy locations in Sonoma, Napa, and Marin County where restaurants are hidden away and they are booming. If the concept is right and a handful of other things are right, you can be a restaurant operator can be successful in an awful location. So let's take location off the board. Let's put that one to sleep. Like I said, it's kind of tired. Undercapitalization, that's a fancy word for an operator going in with very little working capital, meaning not a lot of money in the bank. Again, so my mentor, Tom Barnett, I want to tell this story too. So I used to teach. I taught at the Culinary Institute in Greystone, and I also taught at the Art Institute in San Francisco. I would teach culinary students management classes, and I would have guest speakers, and I would always bring Tom on. And Tom would come in, and the students, he would always, he used to do what I do now, but he was much more on the consulting side too, where I'm mostly a restaurant broker because it keeps me so busy. So the students would always ask, what makes a restaurant successful? Which is just another way of asking, how do restaurants fail? And Tom came in and would speak, 5 or 6 times. And the first time he said something, and the second time he said something different when they asked that question. The third time, something different. Every time he came in, he would answer the question with a different answer. So I'm like, wait a second. So I think that is a great example that it's a combination of things. Sometimes it's a combination of a couple of things of why a restaurant fails. There is no global, this is why. If you look at a tin, it might be missing, kind of like I said, in California with retail sales tax, this other shadow reason that isn't always obvious to people why a restaurant might fail. So undercapitalization, Tom was he was my restaurant broker when I bought my restaurant. I just bought the assets, and when it got to time to open the door, after I went through the health department and I remodeled, I did all these things, are you ready? I had $10,000 to open that restaurant. Now, I already had a lot of my inventory, but you guys, $10,000 is nothing. That's not, that doesn't pay for a week's of food and alcohol and wages, right? And Tom said to me, Rin, what I've noticed is people who open up with a lot of money, they will always throw money at the problem without figuring out what the problem is, and more importantly, fixing the problem. Well, I can tell you, I was fixing problems. And it wasn't just me, and I'll talk about this a little later. I'll touch on this more deeply later. When I started my restaurant, I knew what I didn't know, and it was vast. There was so much I didn't know. I got consultants. I had Tom. I had a CPA and a bookkeeper. I put a lot of people in places, and then I asked them questions, and more importantly, you know what I did? Wait for it. I listened to their answer and implemented the changes they told me to make. Entrepreneurs don't often like to listen to other people, and they don't like to take advice from other people, but it saved my butt. I'll save more stories about that for another time, but I just want to say that, when we hear that restaurants fail in a year, 3 years, or 5, I think that's what accounts for it. Somebody that goes in and has a lot of working capital in year 1, throwing money at the problem. You've got too much staff on the floor at one time, or you're paying them too much. You're not going to fix that problem. You're just going to pay payroll with what you have in the bank. Same with cost of goods sold. If you're up, actually let me roll into margins. So another reason that a restaurant would fail is not enough attention to margins. And in our industry, the margins are known. Cursory web search, boom, there they are. This is what I should be paying in cost of goods sold. This is what I should be paying in labor, and then the rest, and inside of the rest is occupancy costs. So those three. So if your cost of goods sold and your labor are too high, more than likely, what's happening? You're not charging enough for your product. Your prices are too low. But in our industry, it's so competitive. The market knows what a taco costs, right? The market knows what a smoothie costs. The market knows what, a bowl of ramen costs. So you're knocking against your competitors with those prices. So restaurant operators are very reluctant to raise prices. One thing they will do in our region, because if we have living wage, we have a lot of things that can put a lot of pressure on restaurants towards their bottom line. So what a lot of my colleagues and my clients will do is they'll put a surcharge at the bottom. They'll put a surcharge on the guest check, and they'll explain in pretty good detail what that surcharge pays for on the menu. Okay, so what have we got? We did location, we did undercapitalization, we did margins. I gotta look at my notes. Lack of experience. Yes, but not an overarching yes. So when I opened my restaurant, I had been a chef. I'd also been a personal chef. So unfortunately, I was a personal chef to a movie star, and I had an unlimited budget. So I really didn't get any budgeting experience. I got to buy whatever I wanted, which was so wonderful. But I had no management experience. I'd never managed other people. I had very little management experience. I had no front of the house experience. I had no bookkeeping, financial information, nothing. So like I said, I got that support. That's how I filled in those deficiencies with people who did know. And then I learned how to do it. I learned how to read a profit loss statement, which I did. When I sold my restaurant, I had no idea what the balance sheet was. I didn't know what the balance sheet was until I got an MBA years after I sold my restaurant. So yes, you need experience. Front of the house, general management experience is great. Almost all of my buyers are first-time restaurant owners, and they have some variation of experience. Some of my buyers might not have any experience, but they have a lot of money. So they're putting people in place. They're hiring staff that does have experience. So yes, experience is one of the things that Tom would say, and I think he landed on this, that this was the most important: consistency. Consistency in the food, consistency in the service. And I'll tell you guys, in a post-COVID world, consistency is rough. You're probably noticing it out there as consumers of food. And I'm just telling you, we got to give those restaurateurs a break, because it's in the North Bay, very hard to staff restaurants. Then you've got to train them up, to train up your staff, and then they might leave. It's brutal out there, folks. But inconsistency is another. If I go and I get one of the most popular dishes at my restaurant was a salad called the Lorelei, and I can tell you, if that vinaigrette and all those ingredients weren't put together the same way every time my guests came to have a Lorelei, they would not be coming back. They came back because they knew what they were going to be getting time after time. So did I do all 5? You're not keeping track. I think I did. And then the sleeper wave of all of these, number 6, coming in, retail sales tax. A lot of new time operators will treat retail sales tax as though it were income, right? At the end of the day, they do their books. Of course, maybe in the end of the day, that was sales tax. They gather up all that money. They put all that money into their business checking account, right? And then it's sloshing around in there until they have to pay their quarterly retail sales tax. I have had okay, let's see, how do I want to say this? The operators that were the most successful, the operators that people were most surprised that they failed because there's a line out the door, super busy, great product, high demand, great reviews. The reason that they closed was because someone wasn't keeping tabs on the retail sales tax, didn't have a separate account. Put your gross sales into one account. That's what you're going to buy your dairy and your proteins and your alcohol within the following week, put the sales tax in another account, and then pay it quarterly. Pay. Because first off, in our region it's called in the state of California, the California Department of Taxes and Fee Administration, the CDTFA, they're going to levy fines and fees for if you're late paying those. It is very hard to recover from non-payment of retail sales tax. So I think that covers why a restaurant fails, the big 5+1. How does that affect the sale of a restaurant? Really, they don't. I just told you, I bought a restaurant that was in a failed location. It wasn't even operating, so it didn't matter whether they were hitting margins or their gross sales or, oh, that's not true. Occupancy costs. You definitely, when I sell a restaurant if I'm representing the buyer, one of the first things I do, I put a spreadsheet together that takes into account occupancy costs, and you know from episode, I can't remember. I have a previous episode that talks about leases and how much rent is too much. Take a look at that, and I talk at length about why restaurants fail because of paying too much in occupancy costs. But basically, occupancy cost is rent and triple net. And that's a fixed cost. I can project it out for, this is your occupancy costs for a year. If that's what you're paying, 7% of that, more or less, this is the gross sales you need to be making annually. And if my buyer, says, you need to be making $1.9 million annually, and my buyer's like, well, the restaurant that I was just working in maybe made 1.1, you know that rent might be too high. Let's look for another place. So yes, if the rent's too high, that is going to affect the sale of the restaurant. If the sleeper wave can get you in restaurant sales too. If the seller is not current on their sales tax, then the CDTFA will be making a demand all restaurant sales go through escrow. Even if it's not operating, and the reason why in the state of California, the liability runs with the assets. Meaning, if I came in here and I bought, the restaurant I bought, I paid $55,000 for the furniture, fixtures, and equipment. If I give a seller $55,000, if that seller had any liens or owed anything, those liabilities were now my responsibility because I gave the seller money for the assets of that building, for those furniture, fixtures, and equipment. So restaurant sales go through a bulk transfer. They go through an escrow. When the escrow opens up, the taxing agencies are going to put demands in. So if an operator is in arrears of the retail sales tax, let's say $45,000, and the restaurant's selling for $30,000, the seller is going to have to put those additional funds in escrow, or escrow will not close. The business will not transfer to the buyer. So that's the sleeper wave of how these are what could cause a restaurant to fail. That could cause a restaurant not to transfer to a new operator. So if you're just joining me, my name is Rin Longmaid. I'm a restaurant broker and consultant and the founder and host of this series, Deep Dish Live, where we explore the business of restaurants for restaurant buyers and sellers and restaurant owners, and the restaurant curious, which is my favorite part. I have a gift card to Yarrow Gifts, and I have to tell you, I'm so busy that I neglected to find who the winner is. I'll find out. I'll post it on Facebook. I'll put it on Instagram. Yarrow Goods is an original textile gift retail location in downtown 4th Street. My friends Grace and Oliver own it. I want to support them. Ed and I did our last Deep Dish Live series, plein air. We were outside. We were talking about the difference between the restaurant sale and a lease. So we were kind of bopping around to some restaurants that were just available for lease. Anyway, I don't know when we're going to air next month. I'll have to figure that out with Ed. But until next time, we'll see you. If you want to follow this series, you'll find me on YouTube. You'll find all these episodes on my website. Until then, take care.